Probability plays a critical role in trading options. Not only your chance of having a winning trade, but also if you should be in the money, at the money, or out of the money. Should it be a debit or a credit trade? Furthermore, it's a factor whether you will be successful as a trader. It's also a factor in balancing risk with reward. A successful trader is always concerned about risk and reward, with the primary concern being risk. In a debit trade, the risk is equal to the cost. Figuring the risk in credit trades falls into two categories: defined risk and others. Vertical spreads are typical of a defined risk trade. It is the width of the spread minus the credit. Trades containing naked puts and calls make up the others. In this case, risk is calculated similar to that of a covered call. It's the price of the underlying minus the credit. For example, suppose you had a back ratio spread on Amazon, with Amazon selling at $298.94. The trade has two short puts and one long put at a higher strike. The credit is $228, and the spread has a net of one negative put. The risk is $298.94 minus $2.28, or $296.66. Credit trades have a higher probability of success than debit trades, which usually also carry a higher risk. Understanding why is a vital key to your being a profitable trader. Debit trades mean paying to enter a trade. Credit trades receive a credit when a trade is opened. This is a table of August expiration call and put option price quotes for SPY on 7/17/2013. When the data was captured, the price of SPY was $167.80. The out-of-the-money quotes are in bold. The grayed outlines are in the money. The left side is for calls, and the right side is for puts. The POS column shows a probability of success when selling in options for each strike. The further the strike is out of the money, the higher the probability of success, and a lower amount of credit is received. This should not be a surprise, as in any investment, greater risk equates to a higher potential return. I use a probability of success for choosing my strikes. In this table, a number of debit trades in pink are compared with credit trades in green. The name of the trade is in the first column. The middle column has its maximum potential return, and the last shows the strategy's probability of success. You can readily see all the credit trades have a higher probability of success than their counterparts. Detailed explanations are in the following slides. When you buy an ETF of the S&P 500, it is a debit trade with a 53% statistical probability of being a winning trade. Potentially, its return is unlimited, though this is unrealistic. This is typical of all debit trades. Credit trades give up this profit potential of unlimited profits in exchange for a limited profit along with a higher probability of success. The profit-loss chart is on the bottom. The debit trade, in this case the long stock payoff, is displayed in red, the credit in blue. The credit trade reaches its maximum potential if SPY remains above 166, while the debit trade needs SPY to reach 171.50 in order to achieve the same profit of $3.74, or $37.40. Namely, the long stock strategy requires SPY to move up 4.675 times further than the covered call to catch it. You can see the long stock strategy starts to be a losing trade when the price falls below 168, while the covered call is profitable down to 162 and change. The chart shows the debit trade carries a dollar for dollar greater risk. The bull put credit spread doesn't require any stock price movement in order to realize its profit. The only requirement is for the price to remain above 167. The long call requires a move up to its cost, $1.83, plus 64 cents to match the credit spread. This only has a 44.16% chance of happening on the August expiration date. In contrast, the put spread has a significantly higher 60.45% probability of success. Again, you can see in the profit-loss chart that the credit spread becomes profitable sooner and its loss profile is better. The probability of success when buying a long 167 put is 43.53%. In contrast, the bare 169-171 call credit spread is further out of the money and has a much higher probability of success, 61.50%. It only requires SPY to remain below 169 for the next month to realize its maximum potential return. The profit-loss chart exhibits the same characteristics as the previous. However, the long put offers better protection against large losses. The at-the-money short straddle credit trade shows a profit as long as SPY doesn't move more than 5 points up or down. On the other hand, the long ATM straddle position doesn't show a profit until SPY has moved at least 5 points. This is why there is such a difference in their probabilities of success. Here the profit-loss pattern changes. The debit trade has a smaller risk. If you anticipate a large price move, the debit trade is the choice. The strangle is set up like a straddle, but the strikes are moved out of the money. The 170-166 credit strangle has over a 66.67% advantage compared to the debit strangle. The risk-reward characteristics of this chart are the same as the straddles. The maximum potential profit of debit spreads is significantly greater than credit spreads. However, the probability of a debit spread ever achieving the same level of profit as a credit spread is always poorer. A debit spread requires a much greater price movement of the underlying. This explains why the probability of success for credit spreads is always higher. This understanding is reflected in the probability of success numbers shown on the Thinkorswim option chain table shown earlier. Credit trades have another advantage over debits. Credits generally have less capital tied up per trade, especially in margin accounts. This implies you can afford more credit trades, and your return on capital will be higher. Higher trade rates will bring your portfolio's trade success rate closer to its theoretical probability of success rate. These examples show why I recommend high probability credit trades over debit trades. This plan will give you the opportunity to trade frequently and trade small with high probability options. This is the key to becoming a successful trader. Thank you for watching this video. Email me, Dr. J, at The Option Shepherd for information about my guided help building your equity with these unique conservative strategies. Live trading from March 2012 to August 2013 showed close to 95% winning trades. The compound rate of return was over 30%. You too can enjoy this rate of trading success. See my other videos on YouTube.